Welcome to the Investor Lens series. In each episode, I take a famous investor, someone with a documented, verifiable framework, and apply their criteria to ASX-listed companies. Today, we're looking at Warren Buffett. Buffett has spent more than 60 years explaining what makes a great business. Not just a cheap stock, but a business that can compound for a long time. So in this video, we'll turn Buffett's ideas into a simple ASX screen. Then we'll ask, which ASX companies come closest?
Before we do though, quick disclaimer. Nothing in this video is financial advice. I'm not a licensed advisor. This is purely educational. Do your own research. Talk to a professional if you need to. All right, let's go.
Warren Buffett has run Berkshire Hathaway since 1965. What makes him useful for this series is that he explains his thinking very clearly, especially through his annual shareholder letters. Buffett started as a Benjamin Graham-style value investor, looking for cheap stocks. But over time, helped by Charlie Munger, he moved toward a different idea: buy wonderful companies at fair prices. That shift is important. Buffett is not just looking for something cheap. He is looking for businesses that can stay strong for decades. So what does Buffett actually look for? I went back to the primary sources, the annual letters, the fortune interviews, the owner's manual he published in 1999, and pulled out 5 non-negotiables. First, economic moat. The business must have a durable competitive advantage. He's written about this since 1986. Second, high return on equity with low debt. Specifically, he wants ROE consistently above 15%, without needing leverage to achieve it. Third, management integrity. He won't work with people he doesn't trust. Full stop. Fourth, consistent earnings. Not just growing earnings, consistent ones. He wants a reliable earnings record going back years. Fifth, pricing power. If a business can raise prices without losing customers, it has something special. These 5 are hard filters. A company that fails any one of them doesn't make the list.
I started with the ASX 200. Then I removed companies that don't really fit this Buffett-style lens, like resources, airlines, and pre-revenue businesses. That left around 120 companies. Next, I applied a basic size and history filter, market cap above $300 million, and at least 3 years of audited results. Then I focused on sectors where quality screens usually work better: technology, healthcare, consumer platforms, and financials. After applying all 5 non-negotiables, 6 companies passed. Today we'll look at the 2 closest fits, plus 1 company that looks like a Buffett pick, but may not pass this lens. The closest fit is REA Group, ticker REA. REA runs realestate.com.au, Australia's dominant property listing platform. Its moat is very strong. More listings bring more buyers. More buyers attract more agents, and more agents create more listings. That loop is hard to break. REA also has high returns, low debt, strong earnings history, and clear pricing power. Agents keep paying because the platform is where the buyers are. But there are 2 gaps. First, REA is not really a direct consumer revenue model. The money mainly comes from agents. Second, valuation matters. A wonderful business can still be expensive.
The second close fit is Technology One, ticker TNE. Technology One sells enterprise software, mainly to government, education, and large organizations. Its standout feature is consistency. The company has delivered more than 30 years of profit growth, which is very rare on the ASX. It passes the main Buffett-style tests: moat, strong returns, low debt, consistent earnings, and pricing power. The main gap is that it is not a consumer brand. It is a business-to-business software company. Now, CSL is interesting. At first, CSL looks very Buffett-like. It has a strong moat, global scale, and long-term earnings growth. But this screen says no. Why? Because CSL is more leveraged after the Vifor acquisition, and it needs significant capital investment in plasma collection and manufacturing. So the lesson is simple. Even great companies may not fit every investor's framework.
This screen is only a starting point. It cannot fully judge management quality. Numbers can tell us a lot, but they cannot fully show culture, honesty, or capital allocation skill. It also does not solve valuation.
A great business at the wrong price can still be a poor investment. And finally, there is a scale issue. Buffett usually looks at very large businesses. The ASX is much smaller than the US market, so we can apply the principles, but not perfectly copy the scale.
The key Buffett lesson is this: the best businesses earn high returns, and they protect those returns from competition. That is why moat matters. That is why low debt matters. And that is why consistent earnings matter. REA and Technology One both show parts of that pattern on the ASX. But valuation still matters. Management still matters. And this screen is not a final verdict. It is just a better starting point for thinking clearly.